Hey everyone, it's Zack Beck. In spite of the global pandemic, the stock market has been on a tear over the last year, with the S&P 500 having a record close nearly 33 times during the course of 2020 alone. Now, many experienced investors are questioning whether this record-breaking rebound occurred too quickly and if there was too much going into the stock market as a whole. And as a matter of fact, a recent survey was conducted where nearly 66% of investors believe that we are in a bubble territory right now, with another 25% of investors believe that we are approaching a stock market bubble. So what I want to do in this video is explore both sides of the debate, understand whether or not we are currently in a bubble in the stock market or we're fast approaching one, and determining what's going to be most effective for you to move forward and achieve your long-term financial goals. So let's take our time, dive in the details, and jump into it right now. So you might be asking yourself, what is causing this type of bubble outlook? Now, 3 in 5 investors believe that volatility is going to pick up in the market during the course of the next quarter, and ultimately they believe that we're currently entering into the phase of a bubble. Now, there are various factors that could be contributing to this. One is that individuals believe the stock market is very expensive right now, believing that individuals have an inflated view of where the stock market is, almost as if it is separated from the economy. Because let's remember, when the pandemic first struck and businesses were forced to close, individuals lost their jobs or were furloughed, the government stepped in to increase the amount of spending, the Federal Reserve cut interest rates down to near zero, and a lot of the money that was then sent out either via stimulus or other payments into individuals, a lot of that money found its way back into the market. So we might be seeing a slightly inflated market with prices higher than they should be. Another contributing factor could be evaluation metrics such as the forward price earnings ratio that's associated with the S&P 500. Now, this is beyond the 5 and 10-year averages that we've experienced previously, so individuals believe that perhaps we are overvaluing where the S&P 500 is right now. And it might be easy to do so because when you consider that groups and companies such as Tesla just joined the S&P 500 and causing it to grow over time, most of the tech stocks in that FANG category are really causing a lot of this growth and fueling it long term. So what we're seeing is it might be that the S&P 500 could technically be overvalued, or at least perceived to be overvalued by the overall investors who are contributing to this survey. So it's something to factor in right now. It might not necessarily be true, but it could be fueling the type of outlook that a lot of people are maintaining right now. Another variable to take into consideration is the fact that longer-term interest rates have actually risen recently. Now, I know I just previously mentioned that the Fed had cut interest rates across the board and doesn't plan to raise them for the next few years, maybe to 2023 or 2024. However, when we're looking at the 10-year bond, it's actually increased a little bit. Now, this is generally a positive sign for the economy, but what you will find is that as interest rates increase, you're going to find that creates a bit more headwind for stocks, and it also cuts into corporate earnings because people and companies have to pay more to borrow money to invest into their research and development. So there's a lot that goes into this where you could see this as a potential indicator. It isn't necessarily that it is the case, it's just something that could be fueling this outlook right now. There's also the possibility that the stock market has already priced in a lot of the good news that we've experienced recently, such as the fact that vaccines have been developed and they're beginning to be distributed out into society, hopefully allowing the economy then to open up sometime by the late spring or summer of 2021, which once again would then fuel the overall economic development and growth in our country and hopefully attribute to the stock market being able to have a bit more development and growth. But if we're only seeing that all of that good news has already been integrated into the stock market's pricing, it could mean that we're peaked out right now. And once again, this is just a couple of the factors that could be actually contributing to people thinking that we're heading into a bubble or that we are in a bubble. They're not necessarily indicative of the fact that we are. This is just one side of the debate, and it could be fueling a little bit of this pessimism. I generally have a bit more of an optimistic view right now, as I believe that a lot of the trends we are seeing are continuing to move forward long term, and we do want to maintain a long-term horizon when we're considering our investment strategies. So it's just something to bear in mind, but once again, I just want to bring this to your attention because it is beginning to gain a bit more traction where people believe either the stock market has hit its peak or we're heading into a bubble or that bubble is about to burst. On the other side of the debate, individuals are feeling a bit more optimistic when it comes to the stock market. As a matter of fact, in the same survey, nearly 57% of investors have an optimistic viewpoint or a bullish outlook when it comes to stock market moving into this year. And that might be fueled because of the vaccines that are being distributed, the overall news that potentially will be able to open up the economy later this year, and ultimately we have a bit more political stability right now, which is also contributing to a more calm environment long term for the stock market. So there are a couple of variables that we want to take into consideration. In addition, the fact that other industries that generally were hit hardest at the beginning of the pandemic are starting to see a bit of an uptick, and specifically in the energy sector, and because of that, you're seeing people have a bit more of an optimistic viewpoint. And on the news of interest rates potentially rising, the individuals who maintain an optimistic viewpoint believe that those interest rates going up actually could be a good thing because they're indicative of the fact that we're going to be opening up the economy again. We're going to be able to have a bit more of a better financial long-term outlook when it comes to our economic news. So from that standpoint alone, I think it's interesting for us to be able to be aware of why people might be having a bit of a negative view versus a long-term positive view when it comes to what's going to happen with the stock market as a whole. Now, another variable to take into consideration is we're going to enter into a post-pandemic economy in the future, and there might be some changes that occurred during the economic downturn when the pandemic first hit that actually might continue long term, such as working from home, becoming a bit more efficient with our overall workplaces, and also people not doing as much out in society. Maybe they're now just going to exercise in homes and not going to go to the gym as much. Maybe they will travel less. Maybe they won't spend as much out in the economy because they're saving more, which we've found historically a lot of people are saving a lot of money right now because they can't go to restaurants, do other things. Now, I think there are some of those changes that might occur where we might see more remote work long term and some of those other variables, but when you think about it, people are going to eventually gravitate back towards their prior approaches towards life, especially as they begin to feel more comfortable to be out in society, contributing to the economy, and spending money doing activities that they did back in 2019, 18, and before. I know for myself personally, my wife and I are super excited to be able to go and do international travel again because that's something that's super meaningful to us. So that's spending that'll go into the economy in other countries and also here in the United States, paying for airfare and other things as well. So I personally think that when we're doing this right now, we're going to see some long-term implications that could be positive, maybe a more efficient workforce, not requiring people to go into the office and either drive in or take public transport or anything like that. So that might cause us to have less carbon emissions, which helps our overall environment, etc. But when you think about what's going to happen for people's overall spending, it'll probably continue to go along the same lines it was before, just going into maybe slightly different areas. So I think that is actually a positive indicator for the economy as a whole and for the stock market as a whole. So I would say I'm more in the bullish category right now, even if we see something negative that does occur where it does cause stock prices to go down. I personally believe that overall we're going to have a better long-term outlook, even if we have a bit of a roller coaster ride to get there. Now you might be asking yourself, Zach, what should I do relative to this experience right now where the stock market is either in a bubble or potentially going into a bubble? Now I want to be the first one to tell you that you should not panic because what happens is sometimes bubbles can wreak havoc on our overall investment strategy, especially when we saw the volatility that occurred once the pandemic hit. We thought the stock market was going to crash. We thought that it would be almost an impossible time to invest, and people were really scared at that time, which was totally legitimate because our emotions are just going through the day-to-day issues associated with trying to survive through a pandemic, and now we're looking at what are the long-term prospects of our overall investment strategy. So what I would say, there are 3 things that you and I can focus on doing right now to be able to be prepared so that way we're going to be okay no matter what happens, whether we're in a stock market bubble or whether or not we are going to go into one. So the first thing would be this, is to adjust your asset allocation. And what that means is basically how much money do you have invested into stocks versus how much money you have invested into bonds or some other approach that you're going to take. Now, personally, I invest in a strategy that is similar to what Warren Buffett recommends, where he recommends that you have 90% of your portfolio in stocks and 10% into bonds. Now, that's also because I'm relatively young as it relates to my retirement age long term. So I can afford to be a bit more aggressive and weather the storms accordingly. But let's say if you're approaching faster towards retirement, maybe you're in your 50s or 60s, you might want to adjust your asset allocation and have more money attributed into bonds as opposed to having it into the stocks themselves. And that basically acts like a ballast and kind of keeps things a bit more stable if we have some turbulence long term, especially if a bubble does occur. But that's up to your discretion, and one thing that you really want to bear in mind. Now, if you have a diversified portfolio where you have a pretty balanced approach, just don't be too worried when it happens if we do end up having a bubble burst, or if we don't have a bubble at all. Just kind of continue your long-term horizon and keep moving in that direction. But if you're going to find yourself where you're actually having to make a decision when it comes to your asset allocation, just try and find a ratio that is comfortable for yourself. A second thing that you can do in spite of a stock market bubble is to put more money towards an emergency fund. And you hear me talk about this frequently on the channel because I believe it's very critical for all of us to have set aside at least 3 to 6 months of our living expenses so we can weather any significant storm that comes our way. And especially if you're anticipating some sort of a stock market bubble or anything where it's going to cause the prices to devalue and depreciate, you want to make sure that at least you have some cash on hand somewhere where you can actually allocate your money and be able to pay your bills, such as your rent, your mortgage, your grocery, your car, whatever it might be for yourself. But if you have that money there, it's basically just set aside. It's peace of mind. It's not something you're going to touch unless you need it. It's only in case of an emergency. But I believe that's also something that can provide you with the confidence and comfortable approach necessary to be able to keep your money in the market. Because one of the things you're going to find, and I've heard this said before by Dave Ramsey, is that the only people who get hurt on the roller coaster are those who get off in the middle of the ride. Meaning that if you're going to be in this for the long term and you're investing overall, you want to make sure that you're not going to be selling your assets low and then buying high. You always want to buy low and sell high, or you just want to stay on the ride until you reach your destination. So make sure that if you have that money set aside in an emergency fund, it's basically providing you with significant peace of mind. So that way, if an issue does come up where we're going to find our stock market go down, you're not tempted to then sell all of your assets when they're going to be at a rock bottom price. Hopefully you can just hold on to them and watch them weather the storm. Take this last year as an indication of what can happen with the stock market. We thought as soon as March came around and the stock market started diving, we thought, oh my gosh, it's time to sell everything, when in actuality what was a smart thing to do was actually continue to invest dollar cost average by putting money into the market on an ongoing basis, and also see opportunity. That was a time when you could have invested in Tesla at a very low rate, or you could have invested in some companies that are now rebounded significantly and made significant gains. So you want to make sure that you have the stomach to be able to get through this, and emergency fund is what can really help you throughout the course of this process. The third thing you can do in spite of a stock market bubble is to maintain a long-term outlook. And this is so important that the reason why you or I invest, or we save our money and set it aside, is hopefully so we can use it sometime in the future, preferably at retirement, or if you're wanting to purchase a home or do other sort of big life sorts of things, or you want to live off of dividends so you can retire early, whatever it might be for you. What I would say is if you maintain a long-term trajectory and outlook, realize that the stock market historically continues to move up. It doesn't historically go down. There are dips and there are valleys. There are booms and busts. We had a dot-com bubble. We've had other things burst, such as like when we had treble assets back in 2007, when the mortgage industry just completely collapsed. There are those issues that occur, but then you'll always find it generally tends to rebound over time. So if you're in this for the long haul and you can stomach it, I think it's going to be beneficial for you to maintain that type of mentality, and also allow you to not be swayed too aggressively by what you read in the headlines, what you see on news, and all the influence that people are trying to put on you. Just realize that if you have your clear goals set, you have your approach that you're going to take, and you're only going to modify it, and if an emergency occurs, then you're able to determine that you can move forward and achieve your goals, because that's ultimately what I want for you. Because ultimately, if you're able to do so and get to the approach that you're looking at, it's ultimately going to bring me joy, and that's why I create these videos, to help people maintain the proper viewpoint and hopefully encourage you in case you are getting a little bit nervous with what you're seeing in the headlines. But on the flip side of that, another thing to take into consideration is we might just be on a continual upward trajectory for a bit of a time. So it also is a good time for us to be calm. And if you have a solid strategy right now, it should work whether the stock market is up or the stock market is down. You just want to think about that long-term horizon and where you're going to be at the end of the day. With all that being said, I'd like to thank you for watching the video today. If you wouldn't mind, please like the video. That would really help the channel out for the YouTube algorithm, help push this video to other people who might need to hear it. In addition, if you have any questions, please comment down below. I'd love to interact with you, get to know you, do any research on your behalf, and help you make wise decisions moving forward so that you can achieve your long-term goals. In addition, if you wouldn't mind, please subscribe to the channel. That would mean a lot to myself personally, as I do everything I can to create content that makes a positive impact in your life by encouraging you and myself to lead lives of meaning and purpose, all while maintaining balance and moderation. And if you do subscribe to the channel, please tap the notification bell. That will notify you every time I post a video, which I do on a weekly basis. Once again, I'd like to thank you for watching the video today. I hope you have a wonderful day. Talk to you next time.